Have you ever noticed how some of the most exciting, innovative companies you hear about, well, you can't actually buy their stock? It's not just you. It's a real trend. More and more of these companies are choosing to stay private. And today, we're going to get to the bottom of why. We're solving the mystery of the vanishing IPO.
So yeah, that's the big question, right? Where have all the IPOs gone? You know, the initial public offering, the IPO, that used to be the dream for any successful startup. It was like graduating to the big leagues. But lately, that huge milestone is becoming, well, almost a rarity.
And look, this isn't just a hunch. The data is crystal clear. Ever since the peak back in 1996, the number of U.S. companies going public has basically fallen off a cliff. When you compare the average IPOs today to what we saw in the mid-90s, the drop is just dramatic. So what on earth happened?
Okay, to crack this case, here's our roadmap. First, we'll look at the two very different universes of investing. Then, we'll meet the gatekeeper who decides who gets into the exclusive one. We're going to pinpoint a single law from 1996 that acted as the catalyst, trace the massive consequences, and then we'll get to the final twist, which is all about who's really in control.
All right, so first things first. To really get why companies are dodging IPOs, you have to understand that there are two completely separate worlds where they can raise money. You've got the public markets and you've got the private markets.
And these two worlds could not be more different. Think of the public market like a huge department store. The doors are open to everyone, it's highly regulated to protect you, and it's liquid, meaning you can buy and sell shares pretty easily. The private market, though, that's like an exclusive, members-only club. Getting in is tough, there's way less transparency, and your investment is illiquid. You can't just wake up one day and decide to sell it.
So you're probably wondering, how do you get into that members-only club? Well, you need a key. And that key is a special designation from the SEC, the U.S. Securities and Exchange Commission. This is the official gatekeeper.
And here's the official term for it, an accredited investor. Basically, this is someone the SEC says is financially sophisticated enough to play in the riskier world of private companies and startups. It's a legal status that unlocks the door to that whole private market. So how do you get this key? Well, for most people, the bar is pretty high. We're talking about an income of over $200,000 a year for the last 2 years, or a net worth of over $1 million, not including your house. Sure, there are other ways in if you're a financial pro with the right licenses or an executive at the company, but for the vast majority, it really comes down to wealth. But why even have this rule? It really all comes down to one thing: investor protection. The SEC's logic is that if you're an accredited investor, you either have enough of a financial cushion to take a big loss, or you have the know-how to judge the risks yourself. You can, as they put it, fend for yourselves. Now, for decades, this two-market system just existed. It was pretty stable. But then came 1996, the very same year that IPOs hit their all-time peak, and one single law was passed that completely changed the game.
So to get the impact here, you need a little bit of history. From the 1930s all the way to 1996, raising private money was this complicated dance between federal SEC rules and a whole mess of individual state laws called blue sky laws. And then bam, 1996, Congress passes something called the National Securities Markets Improvement Act, or NSMIA for short.
Before this law, just imagine you're a startup. If you wanted to raise money from investors in California, Texas, and New York, you had to follow the separate, complex rules of all 3 states, on top of the federal rules. It was a nightmare. One former SEC chairman even called it a crazy quilt of state regulations. It was just a massive, expensive headache.
NSMIA basically took a giant pair of scissors and cut right through all that red tape. It established that for most of these big private deals, there would be one single set of federal rules, and those rules would override that whole crazy quilt of state laws. Practically overnight, it became so much easier and cheaper for companies to raise private money from investors all across the country.
And the result of this one simple change? It was immediate. It was massive. It was like a regulatory dam just burst, and a complete flood of new money came pouring into the private markets.
I mean, just look at this number. It's staggering. In the 5 years right after NSMIA was passed, the amount of cash raised by late-stage startups, the exact companies that would normally be heading for an IPO, it shot up by almost 500%. The private money faucet was officially turned on full blast.
And what's really fascinating is where all this new money came from. It wasn't just the usual venture capital funds anymore.
Suddenly, the big players, we're talking private equity firms, huge corporations, hedge funds, even mutual funds, they could all get in on the action much more easily, and they brought enormous pools of capital with them.
So here's the absolute crucial takeaway. The number one reason companies used to go public, to raise a ton of money to grow, was suddenly not the only game in town. For the very first time, companies could get IPO-level funding without actually having to become a public company. They could stay inside that exclusive members-only club and still get all the cash they needed.
And that brings us to the final and maybe most important piece of this puzzle, the disappearance of the IPO. It's not really a story about market failure. It's the story about a massive shift in power. It's not a failure. It's a choice.
See, to understand this choice, you've got to look at what drives people. Founders, the people who actually build these companies from scratch, they care deeply about control. They want to pursue their long-term vision without Wall Street breathing down their necks every quarter. But their investors, especially venture capitalists, they have a different goal. They need an exit, like an IPO, to get a return for their fund and to build their track record. And those two goals, they're often in direct conflict.
And here it is. This is the punchline. Before 1996, the investors held all the cards because they had the money. But after NSMIA, when that flood of private capital came rushing in from all these new sources, the power dynamic completely flipped. Founders didn't have to race to an IPO just to keep their investors happy anymore. They could pick and choose their funding, which gave them the money and the control to stay private on their own terms for as long as they wanted.
So let's just quickly put all the pieces together. The mystery starts with IPOs vanishing. The key clue was a 1996 deregulation law that made private investing way easier. That law opened the floodgates to a torrent of private money, and that new river of cash gave founders, who really value their control, the power to use that money to delay going public, sometimes forever.
And that leaves us with one last, really big question. This whole thing isn't just some abstract financial trend. If the most innovative, high-growth companies are now choosing to build their empires and create their wealth inside that exclusive members-only club, what does that mean for the rest of us? For the average investor who's left shopping at the public department store? What does it mean for our economy when the best opportunities are off limits to the public?